Jeff, I want to go back to this idea of the Powell pause. You mentioned that that would bring stability to rates, that would have implications for credit spreads. But when you look at the cross-asset landscape, if we finally got to the point where the Fed is pausing rate hikes, what would be the asset class that benefits the most?
Well, I think it's money flows at the end of the day, right? And so what we know, and what Eric's showing there, is that the brutality has been in fund flows. If you look at the bond industry, asset managers are in massive outflow mode, right? The only things that have really benefited this year are things that don't have significant interest rate risk, things like loans and floating rate securities. And so I think what you need to see at some point is stability in the performance. I know it sounds kind of contradictory there, but I think what advisors and clients need to see is a zero on the statement. They're tired of seeing the negative sign month after month after month after month, to be redundant. And so I think that stability comes through there. And when you do, the bond market's set up. As we talked about, you're talking about a 9-handle yield in junk bonds. There's things in the investor grade market that have similar yields, right? So you can put together a portfolio of credit today and barbell that with the kind of this risk off asset. Let's just call them 10-year treasuries, 30-year treasuries, however you want to look at it. And if you notice, that part's been a little reluctant to move. It's moving a little more in lockstep with the Fed at this point. But we do think that's an asset class that'll benefit. And look, if you're a risk taker, let's go down in the quality of the fixed income markets. I mean, I'm not touching high yield today. We think that there's been a little bit too much of this belief in the Fed pivot, the risk rally we saw in equities, and so it's looking a little rich again. But there are things in like the securitized markets, they're a little more esoteric, things like commercial real estate where people are extremely nervous that, for a double B portfolio, yield almost 10%. If you want to, sorry, I meant to say triple B. You want to go to double Bs? I mean, you're talking 12 and 13% yields. So, you can make some price mistakes is what we talk about in the bond market, right? When you have yield, right? That carries at 1% a month, right? So from our perspective, when you dig down in credit quality, we think if you're going to do that, that should be a replacement for equity today, right? Because the downside is already priced into a lot of these markets. There can be a little bit more, but if we get that pain, we get that recession, we think the equity market's a little more vulnerable. So I'm waiting to see the fund flow turn, and we haven't seen it yet.